In today's episode of the Daily Brief, I'll talk about two interesting stories. I first talk about why the Indian green bonds are bleeding red, and I then talk about the big things happening in the co-branded credit card space. Welcome to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to other news channels. I'm your favorite host, Kashish Kapoor. Today is Tuesday, 3rd. You can find us on Spotify, Apple Podcast, or wherever you consume your podcast. The Daily Brief is also available in Hindi. And if you like reading instead of watching or listening, you can sign up for our no spam newsletter for a quick rundown. Let's start with the first story. On Friday, RBI auctioned 5,000 crores of sovereign green bonds. These are government-backed instruments meant to signal India's commitment to sustainability while raising funds for eco-friendly infrastructure. In theory, they are safe investments that help the world beat climate change. What's not to love? Except the response was lukewarm at best. Of the planned issue, only 1,502 crore found takers at a yield of 6.79%. The remainder, that is 3,498 crores, was devolved onto primary dealers, meaning the underwriters had to step in and purchase the unsold portion. This is a broader signal that something is fundamentally amiss with India's approach to green finance. Why wasn't there enough demand? And more importantly, what does this say about India's green bond market at large? Before diving in, let's unpack what sovereign green bonds are and the context behind their issuance. You see, a green bond is essentially a loan where the proceeds can only be used for sustainable projects. Think about renewable energy, clean transportation, or climate-resilient infrastructure. These came about around 2007, targeting investors who were looking to put their money towards finding solutions to climate change. The world's first green bonds were issued by the European Investment Bank in 2007. India's debut of sovereign green bond came a decade and a half later in January 2023. So where does the money coming from green bonds go? India's Ministry of Finance has put down stringent guidelines for this under the Sovereign Green Bond Framework. This framework dictates that green bonds must adhere to the Green Bond Principle of International Capital Market Association. Their funds go only to eligible projects like renewable energy, biodiversity conservation, or clean water management. The framework also requires that the use of these funds is reported annually. Here's why green bonds matter. India's climate finance needs are huge. We require around $170 billion every year to meet our climate goals, whereas the actual flows, on the other hand, are just $44 billion. Sovereign green bonds were meant to close a part of this gap while showcasing India's climate commitment to the world. When India issued its first sovereign green bonds last year, they were a resounding success. The 16,000 crore issue was oversubscribed by more than 4 times, and investors were willingly accepting lower yields or a greenium of 6 basis points. Public sector banks and insurers were the main buyers, but even international investors participated, signaling confidence despite volatile global markets. The funds were channeled into high-impact projects like renewable energy installations and sustainable water management. Yet, fast forward a few months and enthusiasm has waned significantly. But why? Why did the latest auction flop? Think of it as though you were looking to invest in these bonds. What would you want? Better returns on your investments, more liquidity, less risk. Only green bonds offer you none of this. Compared to a normal G-Sec bond, you get lower returns, poor liquidity, and no real benefit. Green bonds, by their very nature, will give lower yields. After all, they're meant to be cheap financing option for unproven sustainability projects that might otherwise struggle to find funding. The whole point of such a bond is to make borrowing easier than it is, given that sustainability projects are expensive and risky by themselves. But then, why would any investor accept lower returns than a government security, at least without any other benefit in the mix? The other thing is liquidity. There are far fewer green bonds outstanding than the regular government securities. As a result, the market for green bonds is much, much smaller than the 10-year government securities. Moreover, the buyer base for sovereign green bonds in India is extremely narrow. It's basically institutional investors like banks and insurers. Retail participation is virtually non-existent because retail investors typically stick to well-known, high-liquidity products. Without strong secondary markets or innovative structures like tax benefits or risk-sharing mechanism, there's nothing to entice them. All in all, there are fewer people trading in these bonds. So even if you buy a green bond, selling it is much, much harder. Your money essentially remains locked in it for a very long period of time. As Vikas Goel, who's the CEO of PNB Guilds, put it, even though the yield is similar to what a 10-year benchmark was auctioned at, this is a different bond. There is no sufficient outstanding in this bond, so there will be no liquidity. It's like having another 10-year security. And since it can't be traded in the secondary market, no one will take large position on this. If you're looking for a safe place to park your money, there is almost no reason for you to choose green bonds over G6, except maybe you'll feel like a better person. After all, green bonds are an unproven product which fetches you less money and are far harder to sell. Even institutional investors, in fact, aren't enthusiastic about it. SBI chairman CS Shetty explained the broader challenge. He said, if investors have to take a lower rate of interest, awareness needs to be created, and we are probably not ready for that. If we are not pricing these green deposits differently, then there is no differentiation at all. What's missing is some sort of incentive, which would help investors ignore the disadvantages of green bonds. Other countries have found their own ways of doing so. Europe mandates specific institutional allocations to ESG products. Brazil ties its green bonds to clear national priorities like Amazon preservation, making them even more appealing. In India, meanwhile, there is no such obligation, leaving green bonds to compete directly with regular bonds on purely financial terms and losing. Globally, green bonds are booming. The market hit $575 billion in 2023, driven by strong regulatory frameworks and incentives. These measures create demand even when yields are lower. Without mandates or incentives, Indian green bonds here must stand on their own merit, which, from an investor's perspective, currently don't really stack up. The failure of this auction isn't just about bad timing or market conditions. It's a wake-up call for policymakers. Green bonds aren't conventional financial instruments. They're tools to align market forces with sustainability goals. If they're going to succeed, the government needs to make them worth investors' while. At its core, the challenge isn't just about selling bonds. It's about rethinking the way India approaches sustainable finance. If ESG bonds are always going to be less attractive financially, the government needs to think harder and smarter about how to make them desirable anyway. Now, on to the next story. Bajaj Finance is taking it slow in its co-branded credit card business, it seems. They've ended their partnership with RBL Bank and DBS Bank India recently. If you have one of those cards, no worries, they'll still work, but no new card will be issued under this partnership. Now, why does this matter? Are co-branded credit cards even that big of a deal? And wait, how do these partnerships even work? And why are they fizzling out? We're going to answer these questions for you today. So let's break it all down. First, what exactly are co-branded cards? Co-branded cards are a team up between a bank and a brand. The brand gets its logo on the card and through some nice perks, keeps its customers logged in. The bank takes care of the credit and gets to sign up some new customers. And you, the customer, get perks like discounts, cashback, or loyalty points. Take the ICICI Amazon Pay card, for instance. It got you special offers if you shopped on Amazon, turning online shopping into a cashback bonanza. Similarly, the HDFC Flipkart card could make your big billion days feel even bigger. And if you were a Diljit Dosanjh fan, the HDFC Pixel concert card got you the backstage access. Co-branded cards were a win-win-win solution, keeping everyone in the system happy. Here's how everyone was happy. First, the banks. The co-branded cards are a gold mine for acquiring customers. A loyal Amazon shopper, for instance, is more likely to grab an Amazon branded card. And once they do, they're sticking around. Because why wouldn't they use a card that gives them exclusive rewards for a website they already spend a lot of time and money on? On top of that, banks see higher transaction volumes as co-branded card holders tend to use these cards more often. In fact, these cards drive 1.2 times higher spending than traditional cards and have an activation rate of 70% higher. Second, the brands. For the brand, it was all about locking in customer loyalty. Think about it. If you've got a card that earns you a reward on, let's say, Flipkart, you'll probably prefer them over competitors. And more shopping equals more stickiness. The more you get used to a service, the less likely you are to drift towards competitors. Only some brands were finding new users for this product. And finally, the customers, that is you. You get perks that actually feel valuable. As I mentioned, cashbacks, discounts, and loyalty points. You're spending the same money but getting a little extra back. It's a no-brainer. For banks in particular, these partnerships were genius. They attract loyal customers and keep them coming back. As per a few industry reports, these cards jumped from just 3 to 5% of the credit card market in FY20 to 12 to 15% by FY24. And the growth shows no signs of slowing by FY28. They're expected to make up 25% of all credit cards, growing at a shocking 35 to 40% CAGR annually. Let's take RBL Bank as an example, one of the Bajaj Finance's partner. Bajaj Finance was a major source of new clients for them, driving over 70% of RBL's credit card acquisition at one point. Even recently, 36% of their cards were sourced through Bajaj. That's a big deal when you realize RBL's credit card portfolio hit 17,538 crore last quarter. Just imagine more than a third of that coming from just one source. It's clear why banks love them. They're a growth engine that's impossible to ignore. However, over the last year, things have been less rosy for this product. Back in March 2024, the RBI started clamping down on co-branded cards. Why? For one, brands didn't just see these cards as a way to hold on to their customers. They also saw these as a way to get their hands on new source of data. RBI found that some banks, such as Federal Bank and South Indian Bank, were sharing customer data and risk scoring with their brand partners, stuff that should have stayed private. As a result, the banks were told to stop issuing new co-branded cards until they fixed compliance issues. Others, meanwhile, were playing fast and loose with how these partnerships worked. For instance, some co-brand partners like OneCard were marketing their cards as if they were solely their own, instead of clearly showing they were co-branded with a bank. That's a big no-no under RBI's rules. Some co-branded cards weren't even real co-branded cards. They were instead partnerships where two entities handled different parts of the core credit card business. In Bajaj Finance's co-branded cards, for instance, Bajaj Finance was really working like a collection agent for the bank, earning money by using their expertise in collecting dues. So now the RBI has tightened the screws. It has restricted what co-brand partners can get out of a partnership. They are not limited to just sourcing cards and providing access to their goods and services. That's it. They can no longer handle critical aspects like collection. For Bajaj, this was a deal breaker. It essentially took away a key part of what made co-branded cards viable for them. The RBI's guidelines are now crystal clear. Co-brand partners can't access transaction data. Banks must clearly identify themselves as credit card issuer. Marketing has to be transparent. It's a co-branded card, not just the brand's card. And finally, co-brand partners are restricted to sourcing and can't manage post-issuance processes like collections. The goal was simple: protecting customer data, ensuring transparency, and keeping the system clean. For Bajaj Finance, this was a tipping point. Their real value lay in collections, where they had built considerable expertise, operating in over 4,200 locations. But under the new rules, this isn't something they can do anymore. That took away a key part of their business model, so Bajaj decided to exit and focus on other areas. So what's the key takeaway here? Co-branded cards are still a major part of credit card industry. They're a win-win when done right. Customers get perks, brands build loyalty, and banks grow their business. But with tighter regulations, the scope of these cards might be shrinking. And this is why it has sent companies like Bajaj Finance back to the drawing board. Now, moving on to the tidbits for the day. First, India's luxury market is booming, with Louis Vuitton, Christian Dior, and Hermes clocking combined sales of 1,400 crores in FY24. Rising disposable incomes and aspirational customers are driving this surge, with projections suggesting that the market could hit $30 billion by 2030. Second, India plans a 9,000 crore scheme to localize battery manufacturing and reduce import reliance. By targeting key components like cathodes and anodes, the initiative aims to make EV affordable and position India as a global battery hub. Number 3, passenger vehicle sales grew 4% year-on-year in November 2024, with Maruti Suzuki and Toyota leading the charge. Rural demand and festive buying boosted sales, with SUVs becoming a key driver of consumer preference. Next, Donald Trump has threatened BRICS nations with 100% tariffs if they pursue de-dollarization. The aggressive stance underscores US efforts to preserve the dollar's dominance amid growing global pushback. And finally, the Indian government has withdrawn the windfall gains tax on crude oil production and exports of petrol, diesel, and ATF after nearly 2.5 years. Introduced during the 2022 oil price surge, the tax, which brought in 25,000 crores in FY23, had become negligible due to stabilizing global oil prices and robust domestic supply chain. That's it for today. This was the Daily Brief. I'm your host Kashish, and I'll see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.